Loretta, welcome. Good to have you on. I'm Brian. Let's talk about inflation, jobs, and maybe a little bit about debt. We had this PCE number. I know it's they always say it's one of the Fed's or the Fed's preferred measure. It can be a little bit wonky to most of our audience. Talk to us about why this personal consumption expenditure index is so important to you and others.
Well, our Fed goal for inflation is termed in that year-over-year change in the PCE. So that's what we're trying to hit at the Fed. And we set a goal of 2%. And today's report was actually, I think, quite positive. If you look at the year-over-year inflation rate in that report, it was 2.2%. So that's a good number. It's actually better than the markets were expecting. Core went up at 10th, but at 2.7 was in line with expectations. And the better news from the report, if you look at what's happened over the last 3 months, the core is, basically running at at the Fed's target, and the total PC inflation is actually running a bit below target. So inflation is doing exactly what the FOMC hoped it would do, in that it's sort of moving down on a sustainable path back to 2%. And that's what they've been looking for. That's what they've been expecting if you look at the forecasts they put out. So inflation's moving as expected, and that was good news from that report.
So should the Fed sit tight for the next few meetings with a half-point cut behind us? Just ride it out, see what happens.
Yeah, but remember, we have a dual mandate at the Fed. And I guess I shouldn't be saying we anymore. But anyway, the Fed has a mandate. That's where the reason to start this phase of bringing down the interest rate came from, is that inflation looked to be on a good path. They're not going to ignore inflation going forward. It really is balancing risk here. And the risk to inflation on the upside have moved down. The risk to the employment have gone up a bit. So they're focusing a little bit more on employment than they were early in the cycle when they started raising rates. And that's totally appropriate at this point, given where things are. Now, the labor market, the conditions remain healthy. There's a low unemployment rate, 4.2%. It's pretty near historical lows. There's been solid job growth, but the conditions are clearly moderating. And that's what the Fed's focused on. They're going to look at that carefully and try to assess whether this is the moderation they've been expecting to see, or whether something's developing that's a little bit more deterioration. And that's the kind of risk they're trying to balance. They want to prevent that. So even though conditions are good now and healthy now, both on the inflation side of the mandate and the employment side, the Fed has to be forward looking, because its policy affects the economy lag. And so it's good to know where the economy is today, but really what they have to focus on where is it going to be tomorrow. And when they're setting and calibrating their policy, that's what they're going to be focused on. So the employment report next week is going to be a key gauge that they're going to be looking at, along with every other statistic that comes in. Of course, lots of data come in before the next meeting to really gauge whether the labor market is on track. But, as they entered this phase of bringing rates down in September, it wasn't going to be a one-off rate cut. It was going to be starting this phase of bringing rates down closer to the neutral rate, because you don't need that degree of restrictiveness that they had before they started this rate cycle of moving rates down. So I suspect, and I think it's been well explained by the chair in the press conference, that they're beginning a new phase. They're going to be moving rates down. At what pace? That's where the data dependency comes in. They're going to be looking carefully at the data to determine whether they want to do another 50 or whether they want to do 25. And unless something really goes differently than anticipated, I don't think they're going to pause at the next meeting, that they'll move rates down.
I suspect, Loretta, your answer may be something effective. It's not part of the Fed's mandate, but I'm going to ask it anyway. We're paying about $70 billion a year in interest on the national debt. We're spending as much on interest as we are in Medicare. We're going to $1 trillion. Does the Fed talk about this? How much, if at all, does interest payments on the national debt come up, if at all, behind closed doors at the Fed?
I mean, it gets discussed in sort of more subtle ways, I would say, in terms of sort of the wherewithal of the economy to have a certain potential growth rate. So as you know, if debt is too high, it can crowd out other investment, and that can affect the potential growth rate. It also affects the long run equilibrium interest rate in the economy. So in other words, if you're thinking about where is a neutral interest rate, right, that's one of the factors that helps determine that. So in that sense, it does have a role to play in sort of thinking, where is the economy going? How do you assess where the neutral interest rate is over the long run? It's not something that is affecting sort of the more recent or current decisions of the Fed on monetary policy, but it is something that does affect sort of when you're thinking about where the long run projections of the economy are going. And the Fed has to take those into account too, because it's determinative of potential growth rates, and potential interest rate, long run interest rates. So it is something that matters.